So, Larry, I really want to specifically start with something you said about the dollar, which really strikes me, that if we really were expecting from the tax cuts and various pro-business policies, we were expecting capital flows back in the United States, which would support the dollar is going the other way, which strikes me not just because of the regulatory changes, but also because of oil as no longer a big import, is remarkable. Why is it?
I think it's because the biggest news in the global economy actually hasn't been anything about Donald Trump. It's been the resurgence of Europe, which was a long time coming, but now seems to have come. And that has led to strengthening in Europe, increased investment flows, the expectation of higher interest rates, and a stronger euro. And to some extent, that same thing has taken place in a number of emerging markets. It may also be that there's some long-run hedging out of the United States, reflecting the substantial political uncertainty that has been introduced. But in any event, if your theory is that you're creating a Ronald Reagan-like domestic boom by making the business environment more attractive, the first implication of that theory is that the currency should go up, as indeed it did when President Reagan was president. And so the fact that it's gone meaningfully downwards is, I think, a powerful piece of evidence suggesting that the Trump narrative isn't really right. It's corroborated by other fairly simple things. If you measure the world stock markets in a common currency, the U.S. has been a laggard over the last year. If you look at IMF forecasts and how much they've been revised upwards, the U.S. has been a laggard over the last year. Yeah. So what really looks like it's happening is there's a global phenomenon that probably doesn't have much to do with who the President of the United States is, in which the United States has shared. And, President Trump isn't the first president to take credit for good news that he didn't cause. And in fairness, he'll be blamed for bad news he didn't cause. So that's what presidents do. But I think objective analysts should understand that any good economic news, at least the good economic news we've seen so far, is not sensibly attributed to the president.
Larry, I want to pick up on that idea. Perhaps President Trump does not deserve the credit for the good economic news in the U.S., but have any of his policies actually contributed to any deterioration of economic indicators or economic fundamentals as you see it so far in his tenure?
No, I don't know that they've contributed to negative indicators so far. I wouldn't want to argue that he has yet depressed consumer sentiment, for example. I think that the fiscal policies, the tax cut in particular, is highly imprudent to expand the deficit substantially at a time when the economy is already near full employment. And I think that's setting the stage for problems down the road. I think the moves, which so far are not that large, to dismantle financial regulation are risky and raise the risks that we'll have a problem down the road. There's a notion that was popularized some years ago, mostly talking about Latin America, of a populist policy cycle, where if one looks at populist leaders, they tend to be able to produce some economic benefits in the short run, but over time, the effects diminish and even turn in the opposite direction. And I think some of the deals-based capitalism that the president has been engaged in is likely to have that tendency. This is going to be an important year. So far, the bark has been much, much worse than the bite on trade. But we'll have to see whether the president means what he says about substantially adjusting U.S. trade policies in a protectionist direction. If he does, that will have adverse impacts on the economy.
We have a question, actually, from a viewer, Larry, that I do want to ask you. A viewer writes in and says, how do you think that the tax cuts are going to expand the deficit? I mean, how big a problem is that? It's $1.5 trillion is the estimate.
It's $1.5 trillion, but it's actually more than that because there are a variety of tax provisions that are only put in place for a few years. And almost certainly Congress will extend when the time comes. And there are a variety of other provisions that don't contribute much to the 10-year cost because they only go into effect a few years hence. So if you look at the new tax structure we're locking in place, it's a substantially more expensive tax structure. It's going to take on the order of 1% of GDP, perhaps a little more. Is that a lot? It's 5% of the revenue that the government receives, actually probably a bit closer to 6% of the revenue the government receives. Is that a prudent thing to do when the debt to GDP ratio is already reaching highs, except for post-war periods? Is it a prudent thing to do when we're already assuming a very, very strong economy with unemployment at 4%? I think not.
Larry, let me talk about complacency. I mean, back in the late 1990s, and again in 2006, you said the only thing we have to fear is the lack of fear itself. And then I want to remind you of something you said actually at Davos in 2007. You said it's worth remembering that markets were very upbeat in the early summer of 1914. So as you look at the horizon right now globally, where are we? Do you see any indication that we may be heading into one of those sorts of situations?
Look, I'm an economist, not a geopolitician, but it seems to me you have to look around and think that this is as tense a year geopolitically as we've had since the Berlin Wall fell. You look at what's happening on the Korean Peninsula. You look at the degree of tumult and change in Iran, and the U.S. Looking like it might back out of the framework that it has with Iran. You look at the rise of increasing authoritarianism in Russia, in China, in Turkey. You look at growing tensions between the United States and China on trade, on issues relating to the South China Sea. And probably most importantly, you look at an American president who is less predictable than any American president has been in a very, very long time. And it seems to me all of that makes the risks geopolitically much greater than we've seen in a long time.
Yeah.
And none of that is in markets. Markets are priced for placidity. They're priced for very low volatility, and perhaps that will prove correct, as it has proved correct over the last year. But it seems to me that it's a moment when complacency is higher, when people learn that you can always do well by buying on the dips, when people think that monetary policy is a salve that can always keep things calm and stable. That's when you have the greater risk of a disruption or an accident.
Yeah.
And you have, I think it has to be said, a team of leaders in the United States who probably don't give most of the rest of the world great confidence in their ability to manage a financial crisis if one were to come.
Yeah.
The Secretary of the Treasury has sacrificed his credibility quite substantially with extreme forecasts about tax cuts paying for themselves and growth rates forecasts that are way out of the mainstream.
Right.
I'm a big admirer of Jay Powell's, and I think he's going to do a fine job at the Fed, but he is new in the position of being the chairman of the board.
Well, Larry, I wanted to pick up on that. In particular, you're talking about potential deepening of the deficit. We know that the Fed is withdrawing stimulus. Right now, the 10-year U.S. yield is a little bit over 2.6%. Where do you see that heading should markets start to realize all of these things that perhaps they are being, in your mind, too sanguine about?
I think it's hard to say because if markets become more alarmed, treasuries are where they go. So I'm not as confident as many observers that yields are going to rise sharply from here. I think there are two scenarios. There's a scenario where the economy continues to grow strongly and where markets stay calm and there is no geopolitical disturbance. And I think in that scenario, you'll see the Fed tighten more than is now priced into the market. And I suspect you'll see some meaningful upwards move in long rates. But there's also a scenario where some of these uncertainties come more into focus. And I think if that were to materialize, you could see equity markets sell off. And in that scenario, I think 10-year yields would meaningfully move downwards from here.
What's the potential low for 10-year yields in that scenario?
Potential low?
Yeah.
Look, I think if we have, I guess the way I would approach that is to say recessions come every so often. The odds on an annual basis of the economy moving into recession are somewhere in the range of 20%, perhaps slightly lower. And I'd be very surprised if we saw a recession where 10-year yields didn't fall by over 100 basis points. And so I'd expect that sometime in the next half dozen years, we'll again see 10-year. We'll see 10-year rates make a new low, probably below 1.5.
So, Larry, finally,
but again, it could easily go the other way for some interval beforehand.
So finally, Larry, to come back to your piece that you wrote this morning, one of the things you really urge the president is to show that he's a reliable and predictable partner, is the way you put it. And you just talked a minute ago about the team around him and whether there's real confidence they could handle a substantial economic downturn. The big news this morning out of Axios is that, in fact, Wilbur Ross may be on the outs, a fairly controversial, powerful Commerce Secretary. Now, I don't know if that's true. You don't know if that's true. But are the people around him, like the Wilbur Rosses, are they contributing to some of the apparent instability or the uncertainty that's being communicated?
Yes. Yes, I think in some ways they are. But something I've learned, whether it's in business or whether it's in government or whether it's in universities, leaders tend to get the subordinates they deserve and the subordinates that they want. And so I think responsibility for the contours of economic policy and for any issues of credibility that may arise really rests with the president. And I think he would find, I suspect, his team better able to implement his desires if he was more steady and predictable in those desires. As I wrote in the piece, David, look, it's very, very easy to go on in a lot of different ways being critical of the president. But I think that the president was elected president because he tapped into some legitimate feelings that the United States needed to look inwards as well as altruistically out to support a great global system, that there were areas of economic diplomacy in which the United States needed to be more assertive than it had been at some points in the past, and that there were many Americans living in the middle of the country who had been forgotten to too great an extent and needed to be more a focus of concern. And I think people are prepared to respond to that message and those concerns if they're led in a steady, predictable, reasonable way. And that's the hope that I have for the president's second year.